the alarm bells are ringing once again in the financial world, with global economic experts warning us about upcoming dangers. In 2023, there's a big problem on the way, a housing bubble that's about to burst. But what makes it scarier is that this bubble is even more dangerous than the global economic crisis we faced in 2008. Warren Buffett, a big shot in finance, has once again said that a big problem is coming, a problem that could really hurt the money markets. Today, we're going to take a deep look at why there's a brewing issue in the real estate market, and it's worse than what we saw in 2008. Many of us still remember those tough times when people lost their homes in what is described as a housing bubble. It all started when the housing market faced a backlash. At that time, the U.S. market got really big. Mortgage brokers got greedy. They started giving loans to people who had fewer chances of paying them back. Those loans were combined into big packages and sold to banks. Eventually, people couldn't pay back the loans, and it caused a big banking crisis. The government had to step in and stop the entire economic machine. The effects of this crisis were felt all around the world, especially in European countries like Greece and Portugal, as American banks were connected to European banks. At that time, the housing bubble was being created. The housing bubble before the 2008 financial crisis was all about a quick and unsustainable increase in housing prices. It happened because of a few things, like lenders giving loans to people with bad credit histories, called subprime mortgages. These loans had low initial interest rates that got really high after a few years, making it hard for people to pay back. Another thing was securitization, where these subprime mortgages were bundled together and sold as securities to investors worldwide. This process spread the risk, but it also made it tough to know the real value of these securities. There was also a lot of speculative buying, where people bought homes thinking they could sell them for a profit. This made the housing bubble even bigger. The housing bubble burst back in 2007 when home prices started to drop. This caused a wave of foreclosures because people couldn't pay back their mortgages. The housing market collapse also led to significant losses for investors who had securities backed by risky subprime mortgages. However, the situation remains grim, echoing the concerns voiced by Warren Buffett. In fact, it's even worse this time due to the actions of greedy investors. Warren highlights the dangers and rightly points out that it's not regular people to blame this time. Instead, it's speculative real estate investors who are using extreme leverage and greed, a dangerous combination that he accurately predicted would lead to a collapse. Warren also notes that even in great locations like New York, there have been instances in the last 30 years where property values swung dramatically. In their residential brokerage business, they observe a slowdown everywhere, especially in the hottest markets. The areas likely to see the most significant decline are the high-end markets, where people buy for investment or speculation rather than for personal use. In Warren's view, these markets are risky because people have borrowed a lot to buy houses. If the house value drops below what they owe on the mortgage, it can cause significant financial problems, especially for those who bought for investment or speculation rather than to live in. He emphasizes that when families stay together and have jobs, even if the market value is less than the loan value on a given day, they don't lose a lot of money. However, in cases of investment or speculation, especially when influenced by day traders, the real estate market can experience significant and sudden fluctuations. Furthermore, Warren underscores that it's the investors who have turned the real estate market into something resembling the penny stock market. They are abusing leverage and focusing on quick flips, treating real estate transactions like day trading on a computer. This approach, according to Warren, is a risky strategy that could lead to substantial market disruptions. Warren's observation holds true as, in recent years, investor activities have seen an increase. This surge has given rise to speculative trading, resulting in risky and deceitful loans. According to Warren, the real estate market exemplifies the extreme impact of the law of the vital few. Unlike stocks that are actively traded throughout the week, providing a continuous live update on prices, Homes are sold based on comparables, comps. These comps often rely on a very limited number of transactions. For instance, you might believe your home holds a certain value because someone nearby sold a similar home for a specific price several months ago. However, this method is an unreliable measure of value, susceptible to significant and swift fluctuations in both directions. A few unfavorable sales can swiftly redefine the value of an entire neighborhood, explaining why real estate crashes can occur abruptly and seemingly out of nowhere. Warren illustrates this by highlighting how investors only need one buyer to purchase at their specified price. Due to the substantial prices in real estate, there's a constant element of hope in the market. All it takes is one buyer unaware of the market's impending downturn to sustain an entire neighborhood. However, once news of the decline spreads, the fallout can be swift, as investors rush to exit the market once the decline commences. Warren went on to explain that he thinks some of the problems that were in the financing of manufactured houses a few years ago have shifted into the financing of regular houses. There's a lot of crazy credit being given out in America for houses, and it had a bad effect on the manufactured housing area. He guesses that there might be some issues in the regular housing area at some point. He talks about the risks of lending money without much thought, saying that it always leads to big problems. The consequences of bad lending practices usually take a while to show up, similar to a sickness that you don't notice for a few weeks. Once it becomes visible, it can spread like an epidemic, and by then it's already a big problem. This is how it works with unwise financing. Warren discusses the history of such problems, mentioning the issues in the 1980s with commercial financing, and the RTC and the savings and loan crisis that followed. The main issue, according to Warren, is that people keep starting projects one after another without really thinking if they're a good idea. He simplifies the process, saying that if a bank gives money for a project, it will eventually get done. This straightforward idea shows how projects happen when there's money available, even if they might not be the best ideas in the long run. In looking at the current situation, Warren sees similarities between the housing bubble forming now and the one that happened in the early 2000s. While things might not be exactly the same, they're pretty similar. This comparison highlights how financial problems tend to repeat themselves if they're not addressed, potentially leading to similar issues. Munger and Buffett might be worried due to the decline in foot traffic around stores in metropolitan areas, which is currently 10 to 20% lower than pre-pandemic levels. Additionally, office attendance has seen a 30% decrease compared to before COVID-19, as highlighted in a recent McKinsey report. This report anticipates that, given these ongoing trends and various other factors, the demand for office space might remain nearly 20% lower in 2030 compared to 2019. As of October 2023, WFH research indicates that approximately 28% of paid workdays involved remote work. Among the full-time workers surveyed, 12% were entirely remote, and an additional 30% followed a hybrid work model. These developments spell trouble for commercial landlords. The situation is even more dire for their lenders. So, to wrap things up, real estate has turned into a modern gold rush, with prices going up steadily and then suddenly shooting up after the events of 2020. Most people agree that there's something not normal about this market, and many see it as the start of a new bubble. Warren Buffett saw it coming and rightly pointed out that the housing market crash happened because some investors took big risks, using a lot of borrowed money and being too greedy. He's warning about the danger of investors treating the real estate market like a risky game, using borrowed money and trying to make quick profits, much like day trading. In this ever-changing market, real estate prices can suddenly drop because they rely too much on just a few transactions to decide how much something is worth. This risk is highlighted by Buffett's belief that the challenges coming in the future will be even worse than what happened during the housing crash, suggesting some tough economic times. The current housing bubble looks a lot like the one we saw in the early 2000s, hinting that history might repeat itself. Investors who are making big price swings in certain areas have the power to cause a sudden change in the housing market. This creates frustration and uncertainty for those dealing with these uncertain times. If you liked the video, do subscribe to the channel and make sure to watch our video on the new Argentinian president and his radical reforms.